Understanding the relationship between interest rates and the Federal Reserve. In the next few minutes, we will explore the relationship between interest rates and the Federal Reserve. We will discuss the role of the federal funds rate, the impact of the Federal Reserve's actions on other interest rates, and how changes in interest rates can affect inflation and borrowing costs. Additionally, we will examine historical examples to understand how interest rates can go up even when the Federal Reserve cuts them. Understanding these dynamics can help individuals and institutions make informed financial decisions. The federal funds rate. The federal funds rate is the interest rate at which depository institutions trade federal funds with each other overnight. It is the only interest rate that the Federal Reserve directly controls. When one bank has excess cash, it lends to other banks in need of larger balances. The Federal Reserve sets a range within which this lending and borrowing can occur. If the rate gets too high or too low, the Federal Reserve intervenes to maintain stability. Other interest rates. While the Federal Reserve's actions can influence other interest rates, it does not directly control them. The interest rates on forms of debt that individuals and institutions care about, such as mortgages, auto loans, and credit cards, are primarily driven by market forces. Lenders consider factors like inflation and expected returns when determining interest rates. However, the Federal Reserve's actions can indirectly impact these rates. Impact of Federal Reserve actions. When the Federal Reserve cuts the federal funds rate, it can lead to lower interest rates on short-term debt, such as Treasury bills. This allows the U.S. government to borrow more and spend more freely. As a result, the money supply increases, which can lead to inflation. Inflation, in turn, can push up interest rates on other forms of debt. Historical examples. Looking at historical examples, we can see instances where the Federal Reserve cut interest rates, but other interest rates, such as the 10-year Treasury bond rate, actually increased. This occurred during the early 1970s when the Federal Reserve's rate cuts reignited inflation. The 10-year Treasury rate, which is closely tied to mortgages and other consumer loans, rose as a result. Implications for the future. We are currently in a time period similar to the 1970s, where many believe inflation is low and interest rates will remain low. However, if the Federal Reserve cuts rates in 2024, it could spark a reignition of inflation. This would result in other interest rates, such as mortgage rates and credit card rates, going up. It is important for individuals and institutions to be prepared for potential changes in interest rates and their impact on various asset classes. Conclusion. Understanding the relationship between interest rates and the Federal Reserve is crucial for making informed financial decisions. While the Federal Reserve directly controls the federal funds rate, other interest rates are primarily influenced by market forces. Changes in interest rates can impact borrowing costs, inflation, and the overall economy. By examining historical examples, we can see that interest rates can go up even when the Federal Reserve cuts them. Being aware of these dynamics can help individuals and institutions navigate the financial landscape effectively.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.